Here's a quick test, and I won't be as strict as Buffett. If the stock market closed for 5 years, would you be comfortable with the companies that you own? In the next few minutes, I'm going to hand you Joel Greenblatt's 3-step playbook for finding dividend stocks that pay you to hold them even when markets crash. I'm going to give you a bakery test you can run on any business you're thinking about buying, 3 simple valuation strategies that you don't need a finance degree to use, and an action plan for every stock you're thinking about buying. Stick around. By the end, you'll know how to buy cash flow and not market noise. First, let's talk about where most investors go wrong. They're investing on charts, momentum, news, Fed decisions, analyst ratings, and they get caught up in all this noise and they forget what we're really buying. Joel Greenblatt said that stocks aren't just pieces of paper that bounce around. They're real ownership shares in real businesses. And most of the market has forgotten that. But here at Compounding Dividends, we haven't. We like to buy stocks the same way that we would buy a local business. We want to see a business that's been successful in the past and has shown some growth. We want something with a bright future, and we don't want to run it. So we want good management in place. And if we can find those things, then we're going to pay a price based on the cash that's going to come out of the business over time. That's it. We're not betting on price movements or Fed rates. We're buying cash flowing businesses at reasonable prices and we're holding on to them. Why? Because businesses create real value and real cash flow, and our dividend payments are real cash from that actual cash flow. We're not betting on somebody else paying us more later. We're getting a real return from the business and not the stock market. We buy them and we hold on for the long term. We're owners. Joel Greenblatt calls that value investing. We call it common sense. So let's think about a real business. Picture maybe a bakery in your hometown. It's been doing well for years, everything's paid for, and the owner comes to you one day and says that they want to retire, and they offer to sell you half the business. You'd ask a few questions about profitability and what do you own and what do you owe, what's the lease like, that sort of thing. But assuming you find out that the business is profitable and you think it's going to do well, you'd ask one question, and that's how much money am I going to be able to get out of this business in the next 5 or 10 years? And am I paying a price today that's worth a lot less? You wouldn't think about flour prices tomorrow or what you could flip the business to someone else for in a year or two or a month or two. You would look at it as if you were going to own the business, operate it, and keep some of the profits. That's exactly what we do here. Now let's talk about that valuation of the business. Here, we tend to use 3 different methods, and I promised you these were easy. So the first is really easy. We look at the current dividend yield and we compare that to what the company has yielded in the past. If it's currently at a much higher yield than it has been in the past, that's an indication it might be undervalued. We might be getting a good deal. So the second way that we look at a business is the earnings growth model. And this takes into account how the earnings are going to grow over time while we own it, the dividend it's going to pay us, and then how the multiple might change based on how the market prices the business. The formula is simple. It's our earnings growth plus our dividend yield plus or minus the change in multiple depending on if we think it's going to go up and down. And that tells us the return that we can expect each year for the time that we own the business. Now, valuing a business admittedly is complex, and trying to come up with the right growth rate and guessing what the market might value it at by the time we're thinking about selling it is difficult. And Charlie Munger has a great answer on how to solve difficult problems, and that's inversion. We turn the problem around. So instead of saying, what do we think the business is worth, we use the reverse dividend discount model to ask, what does the market think that this business is going to do? The formula is pretty simple. To figure out what the market is pricing in, we take our required return from the investment and we figure out next year's dividend yield. So we take what the dividend is going to be next year, we divide that by the share price, and we subtract that from our required return. That tells us how much dividend growth the market is currently pricing into the stock price. And if it's much lower than the dividend growth the business has had in the past, again, it's an indication that this might be undervalued and it might be a good deal. So I promised you a good 3-step action plan. The first thing you should do is think about that business you're thinking about buying, just like that bakery. And ask yourself, has this business done well in the past? Has it grown? Is it going to grow in the future? Are the margins healthy? Has it been able to return a good amount of cash to the shareholders and the owners? If it passes that test, get a feel for management. One of the best ways to do this is to read the last few shareholder letters and annual reports. Do you trust them? Do you like the direction they're going in the company? If you think that management's doing a good job and will run the business well for you in the future, then go ahead and figure out what it's worth. Use our 3 methods and pay a lot less than what you come up with. If you do that, the hard work's over. All you have to do is hold on to the business. If you want more cash flow first investing ideas, go ahead and subscribe to the channel and build your own Berkshire Hathaway with us.